I need to warn you about something that I have been studying obsessively for the past 18 months. Something that the Federal Reserve does not want you to understand. Something that Wall Street is deliberately ignoring because acknowledging it would cause a panic that would make 2008 look like a minor correction. We are on the path to hyperinflation, not the mild 3 or 4% inflation that the government reports, not the transitory inflation that they told you would go away on its own. I am talking about a scenario where the purchasing power of the US dollar collapses so dramatically that the entire financial system as we know it is restructured. And when that happens, and I believe it is a question of when, not if, gold and silver are going to reprice to levels that most people cannot even imagine. I am talking about gold surging 10 times from current levels. I am talking about silver reaching a minimum of $300 per ounce. And I am going to explain exactly why these numbers are not fantasy. They are mathematics. Let me take you back to 2020. That was the year everything changed. Though most people do not realize it yet, when the pandemic hit, the Federal Reserve and the US government responded with the largest monetary and fiscal stimulus in human history. I remember sitting in my office watching the announcements come through in real time. The numbers were staggering. Each program was larger than the last. Each stimulus package broke records set by the previous one. And I remember thinking, this money does not just disappear. It goes somewhere, it changes things. And the changes are going to be much bigger and much more lasting than anyone is currently acknowledging. The Fed's balance sheet went from roughly $4 trillion to nearly $9 trillion in less than 2 years. They created $5 trillion out of thin air. The government sent checks to every American household. They extended unemployment benefits. They launched the Paycheck Protection Program. They passed multiple spending bills totaling trillions of dollars. And all of this money had to come from somewhere. It came from the printing press. Not literally, of course. It was created electronically. But the effect is the same. Trillions of new dollars entered the system, chasing the same amount of goods and services. And what happens when you dramatically increase the supply of money, while the supply of goods stays the same or even decreases? Prices rise. That is not theory. That is the most basic principle in economics. More dollars chasing fewer goods equals higher prices. And we saw exactly that. Inflation surged to levels not seen in 40 years. The Consumer Price Index hit 9.1% in June of 2022. Housing prices exploded. Food prices jumped. Energy costs spiked. Everything got more expensive because the value of each dollar declined. Now, the Federal Reserve raised interest rates aggressively starting in March of 2022. They took the federal funds rate from near zero to over 5% in about 18 months. And inflation did come down from its peak. The headline CPI number fell from 9% to around 3%. And the narrative became that the Fed had won, that inflation was under control, that we had achieved a soft landing, but that narrative is dangerously misleading. And here is why. Before I give you the 5 reasons why I believe hyperinflation is not just possible but probable, and why gold and silver are going to reprice dramatically, let me explain what most people get wrong about inflation. They think inflation is about prices going up. It is not. Inflation is about the currency going down. The prices of goods and services are not rising because something changed about those goods and services. A gallon of milk is the same gallon of milk it was 10 years ago. A house is built with the same materials using the same labor. What changed is the value of the unit we use to measure those prices. The dollar, when you print trillions of new dollars, each existing dollar becomes worth less. And the prices of everything measured in dollars go up accordingly. This distinction matters enormously because it changes how you should think about protecting yourself. This distinction matters because it tells you where to look for protection. You do not need to find assets that go up. You need to find assets that maintain their value while the currency goes down. And for 5,000 years of human civilization, the assets that have best maintained their value during currency debasement are gold and silver. Not because of some mystical property, because they cannot be printed, they cannot be created by a central bank. Their supply is constrained by geology and the physical difficulty of extracting them from the earth. That is their fundamental value proposition. They are the antidote to currency debasement. The first reason I believe hyperinflation is coming is the debt spiral. The United States government currently owes more than $36 trillion. That number is so large that it has lost its ability to shock people. So let me put it in context. If you spent $1 every second 24 hours a day, 7 days a week, it would take you over 1 million years to spend $36 trillion. That is the scale of the obligation, and it is growing by approximately $2 trillion per year just from the annual deficit. Not from a war, not from a crisis, just from normal government operations. Spending exceeds revenue by $2 trillion every single year. But here is the part that should terrify you. The interest payments on that debt are now consuming over $1.2 trillion per year. That is more than the entire defense budget, more than Medicare, more than any other line item in the federal budget. And because interest rates have risen from near zero to over 5%, that interest expense is growing rapidly as old low-rate debt matures and is refinanced at higher rates. Let me show you why this math is inescapable. The average maturity of U.S. government debt is roughly 6 years. That means every year approximately 1/6 of the total debt needs to be refinanced. When that debt was originally issued at 2% or even 1% interest rates during the era of near-zero rates, the interest cost was manageable. But now that debt is maturing and being refinanced at 4 or 5%. The interest expense on the same principal has doubled or tripled, and this process has years to run before all the cheap debt has been refinanced at higher rates. Even if the Fed cuts rates modestly, long-term rates are unlikely to return to the near-zero levels we saw during the pandemic. The bond market is starting to demand higher compensation for the risk of holding U.S. government debt. And as the debt grows larger, the risk premium investors' demand will only increase. This creates a mathematical death spiral. The government has to borrow more money to pay the interest on the money it already borrowed. And because the new borrowing carries higher interest rates, the interest expense grows even faster, which means they need to borrow even more, which means the interest grows even more. I have modeled this out with my team, and under any reasonable set of assumptions about growth, interest rates, and spending, the debt-to-GDP ratio exceeds 200% within 15 years. That is a level that no major economy has ever sustained without a currency crisis. There is no way out of this spiral through normal fiscal policy. You cannot cut spending enough because the mandatory programs, Social Security, Medicare, Medicaid, and interest on the debt consume nearly 80% of the federal budget. You cannot raise taxes enough because higher taxes slow economic growth, which reduces tax revenue, which makes the deficit worse. The only way out, the only way it has ever been resolved in the history of nations that find themselves in this position, is through inflation. You inflate the currency so that the debt, which is denominated in nominal dollars, becomes easier to service. $36 trillion is an impossible burden at 2% inflation. But at 15 or 20% inflation sustained over a decade, the real value of that debt shrinks dramatically. This is not conspiracy theory. This is fiscal mathematics. And every country in history that has accumulated debt at this level relative to its GDP has eventually inflated its way out. Every single one. The second reason is the loss of the dollar's reserve currency status. For decades, the United States has had an extraordinary privilege because the dollar is the world's reserve currency. There is constant global demand for dollars. Other countries need dollars to buy oil, to settle international trade, to hold as reserves in their central banks. This demand has allowed the U.S. to run persistent trade deficits and budget deficits without immediate consequences. We print money, and the world absorbs it because they need it. But that is changing. China and Russia have been actively working to create alternative payment systems that bypass the dollar. The BRICS nations are exploring a common currency for trade settlement. Saudi Arabia has signaled willingness to accept payment for oil in currencies other than the dollar. Central banks around the world have been buying gold at the fastest pace in decades. diversifying their reserves away from dollar-denominated assets. I track these developments very closely because they represent the single greatest threat to the standard of living of every American. The reserve currency privilege has allowed us to live beyond our means for decades. We consume more than we produce. We import more than we export. We borrow more than we save. And the rest of the world has financed this lifestyle by accepting our dollars. When they stop accepting our dollars, or even when they reduce their acceptance of our dollars, the adjustment will be brutal. The price of imports will surge. The cost of borrowing will spike. The government will face a choice between massive spending cuts and even more aggressive money printing. Based on the political dynamics I just described, I know which option they will choose. They will print. When the dollar loses its reserve currency status, and the process has already begun, the trillions of dollars held overseas will begin flowing back to the United States. Those dollars will enter the domestic economy, massively increasing the money supply and driving inflation far beyond anything we have experienced. This is not a theoretical risk. It is happening in slow motion right now, and the pace is accelerating. The third reason is the monetary base expansion that has not yet fully worked through the system. When the Fed created $5 trillion during the pandemic response, not all of that money immediately entered the real economy. Much of it sat in bank reserves at the Federal Reserve. Much of it went into financial assets, inflating stock prices and bond prices and real estate values. But money has a way of eventually finding its way into the real economy. As banks lend more, as consumers spend their accumulated savings, as businesses raise prices to cover their higher costs, that money works its way through the system. Economists call this the velocity of money. During the pandemic, velocity dropped sharply because people were saving rather than spending. But as velocity normalizes, the inflationary impact of all that money creation will become fully apparent. Here is an analogy that I think helps people understand this. Imagine you are in a bathtub and you turn on the faucet full blast, but the drain is also open, so the water level does not rise immediately. The water flowing in represents the money creation. The drain represents the low velocity, the money sitting idle in bank reserves and savings accounts. Now imagine the drain starts to close. The water level begins to rise. That is what is happening right now. The money was created years ago, but the drain, the low velocity, was keeping the water level manageable. As velocity normalizes, as that drain closes, the inflationary flood is going to become impossible to ignore. We have not yet felt the full effects of the pandemic-era money printing, the inflation we experienced in 2021, and 22 was just the first wave. The second wave is coming, and it will be worse than the first, because the debt situation has deteriorated further, the money supply has expanded further, and the structural supply constraints I am about to describe have gotten worse. The fourth reason is the structural supply constraints that are developing across the global economy. The green energy transition requires massive amounts of copper, silver, lithium, cobalt, and other materials. The infrastructure is aging and needs replacement. The reshoring of manufacturing from China requires enormous capital investment, and the labor force is shrinking as baby boomers retire and birth rates decline across the developed world. All of these factors create persistent upward pressure on prices that is independent of monetary policy. The Fed can raise interest rates all they want, but they cannot create more copper mines. They cannot train more electricians. They cannot reverse demographic trends. These supply constraints mean that even without additional money printing, prices would be rising. Add in the monetary debasement I have already described, and you have a recipe for inflation that is far worse than anything the models predict. Let me give you some specific numbers, because this is where the abstract becomes concrete. The International Energy Agency estimates that achieving global net zero emissions by 2050 will require 6 times more mineral inputs in 2040 than today. 6 times. Where are those minerals going to come from? It takes 7 to 15 years to develop a new mine from discovery to first production. That means even if we discovered every deposit we need tomorrow, The supply would not come online until the late 2030s at the earliest. In the meantime, existing mines are depleting, grade quality is declining across the industry, the easy deposits have been found, what remains is deeper, lower grade, more expensive to extract, and in more politically challenging jurisdictions. This is not a temporary bottleneck. This is a decade-long structural deficit. I have spoken with executives in the mining industry, in construction, in manufacturing. They all tell me the same thing. The costs are not coming down. The labor shortages are not improving. The supply chains are not normalizing. A friend of mine who runs a large construction firm told me that his all-in costs have risen 60% since 2019, and he does not see any path to those costs declining. The skilled tradespeople who are retiring are not being replaced by younger workers in sufficient numbers. The cost of materials has risen permanently to a higher level. These are structural issues that will persist for a decade or more, and they represent a permanent shift in the cost structure of the economy that central banks cannot address with interest rate policy. The fifth reason, and this is the one that ties everything together, is the political incentive structure. No politician, in either party, has any incentive to address the deficit. Cutting spending is politically toxic, because every dollar of government spending is someone's income. Raising taxes is politically toxic because nobody wants to pay more. The only politically painless solution is inflation, because inflation is a hidden tax that most people do not understand. It reduces the real value of the debt without anyone having to vote for a tax increase or a spending cut. The politician gets to keep spending, the central bank gets to keep enabling, and the average citizen slowly watches their purchasing power erode without understanding why. I have watched this dynamic play out in real time over 3 decades. Every election cycle, both parties promise to address the deficit. Neither party ever does. The deficit has grown under every administration, Republican and Democrat, for decades. And the reason is simple. The voters reward politicians who give them things and punish politicians who take things away. There is no political reward for fiscal responsibility. There is only political punishment. So the deficit grows, and eventually the only exit is the printing press. This is not new. This is how every democracy in history has dealt with unsustainable debt levels they inflate. And the citizens who do not understand what is happening bear the cost. I have studied the fiscal collapses of Weimar Germany, of Argentina, of Zimbabwe, of Venezuela. In every case, the pattern was the same. Governments accumulated debt they could not repay. They pressured central banks to monetize that debt. The currency lost value gradually at first, then suddenly, and the only people who preserved their wealth were those who owned real assets, particularly gold and silver, before the collapse accelerated. The people in Weimar Germany who converted their marks to gold in 1920, before the hyperinflation became extreme, preserved their wealth entirely. The people who waited until 1923, when a loaf of bread cost billions of marks, lost everything. Timing matters, and the time to act is before the crisis, not during it. Now, let me connect all of this to gold and silver, because understanding why inflation is coming is only half the equation. You also need to understand why precious metals are the primary beneficiary. Gold has been money for 5,000 years. Silver has been money for nearly as long. The reason is simple. They possess the qualities that make something useful as money. They are durable. They do not corrode or decay. They are divisible. You can cut them into smaller pieces without losing value. They are portable. A significant amount of value can be carried in a small space. They are recognizable. People everywhere in the world know what gold and silver are. And most importantly, they are scarce. You cannot create them out of nothing. Every ounce of gold and silver that exists had to be physically extracted from the earth at significant cost and effort. Now, some people will tell you that gold is a barbarous relic, that it has no place in a modern portfolio, that cryptocurrency has replaced gold as the inflation hedge. Let me address each of these objections because I hear them constantly and they are all wrong. Gold is not a barbarous relic. That phrase comes from John Maynard Keynes, who was a brilliant economist but was speaking in the context of the gold standard, not gold as an investment. As an investment, gold has outperformed bonds, cash, and most stock indices over the past 25 years. It has protected purchasing power through every major currency crisis in modern history. It is held as a reserve asset by virtually every central bank on Earth. If it were a relic, why are central banks buying it at the fastest pace in decades? Why did China add over 200 tons to its reserves in just 2 years? These institutions are not sentimental. They are making a calculated decision to diversify away from dollar-denominated assets, and gold is where they are going. As for cryptocurrency replacing gold, I think that argument misunderstands both assets. Cryptocurrency has some interesting properties, but it does not have 5,000 years of history as a store of value. It does not have universal recognition. It requires functioning technology infrastructure to transact. And its supply, while limited for any individual cryptocurrency, is unlimited in aggregate. Because anyone can create a new cryptocurrency tomorrow, gold's supply is constrained by physics and geology. No one can create more gold without mining it from the earth. That is a fundamentally different kind of scarcity. When I say gold could surge 1,000% from current levels, people think I am being sensational. But let me walk you through the math. If you take the total U.S. money supply, M2, which is approximately $21 trillion, and you divide it by the total amount of gold held by the U.S. government, which is approximately 261 million ounces, you get a price of over $80,000 per ounce. That is what gold would need to be priced at for the US dollar, to be fully backed by gold at current money supply levels. Now, I am not saying we are going back to a gold standard, but I am saying that this ratio gives you an indication of how undervalued gold is relative to the amount of paper money that has been created. Even if gold reprices to cover just 10 or 15% of the money supply, which would be a modest partial backing, you are looking at prices of $8,000 to $12,000 per ounce. That is a 4 to 6 times increase from current levels. And if we experience genuine hyperinflation, where the money supply doubles or triples over the next decade as the government inflates its way out of the debt spiral, the numbers get even more extreme. Silver's case is even more compelling. Historically, the gold-to-silver ratio has averaged around 15 to 1. Meaning it took 15 ounces of silver to buy 1 ounce of gold. This ratio reflects the relative geological abundance of the two metals in the Earth's crust. Today, the gold-to-silver ratio is over 80 to 1. That means silver is historically undervalued relative to gold by a factor of more than 5. If gold reaches $10,000 per ounce, and the ratio reverts even partially to its historical mean, say to 30 to 1, silver would be priced at over $330 per ounce. If gold reaches 15,000 and the ratio goes to 25 to 1, silver hits $600 per ounce. These are not fantasy numbers. They are mathematical relationships that have held for centuries and are currently at extreme historical anomalies. But the case for silver goes beyond just the gold ratio. Remember, silver is an industrial metal with growing demand. Solar panels alone are projected to consume over 300 million ounces of silver annually within the next few years. That is nearly 40% of total mine supply going to just one application. Add in electronics, electric vehicles, medical devices, water purification, and you have industrial demand that is approaching total mine supply, which means there is almost nothing left for investment demand. When investment demand surges, as it inevitably will when people realize what is happening to the currency, there will not be enough physical silver available at current prices. The price will have to rise dramatically to ration the available supply. And because the silver market is tiny compared to the gold market, even small amounts of investment inflows will have an outsized impact on price. The entire annual silver mining output, roughly 800 million ounces, is worth approximately $24 billion at current prices. That is a rounding error in global financial markets, A single large hedge fund could buy the entire annual production. When serious money starts flowing into silver, the price impact will be explosive. Let me give you a real world example of how quickly silver can move when investment demand picks up. In January of 2021, a group of retail investors on social media attempted to squeeze the silver market. Within days, physical silver dealers reported being completely sold out. Premiums on physical silver coins and bars jumped to 30, 40, even 50% above the spot price. Delivery times stretched from days to weeks to months. And that was from a relatively small number of retail investors with limited capital. Imagine what happens when institutional money starts flowing in, when pension funds, sovereign wealth funds, and family offices decide they need precious metals exposure. The physical market simply cannot accommodate that demand at current prices. The price discovery mechanism will shift from the paper market to the physical market. And when that happens, the repricing will be sudden and dramatic. There is another factor that most analysts completely overlook. The above-ground inventory of silver has been declining for years. The major exchanges have seen their registered silver inventories drop dramatically. Unlike gold, which is primarily held as a store of value, and very little is consumed, silver is an industrial metal that gets used up. When silver goes into a solar panel or an electronic device, it is effectively gone. It is not economically viable to recover it. So the total above-ground stock of available silver is actually shrinking while demand grows. Some analysts estimate that if current trends continue, the available free floating supply of silver could be critically low within 3 to 5 years. At that point, no amount of paper market manipulation can hold the price down because industrial users will be willing to pay whatever it takes to secure the physical metal they need for their manufacturing processes. So what should you actually do with this information? I want to be practical here. I am not telling you to sell everything and buy gold and silver. What I am telling you is that your portfolio needs to be prepared for a scenario that most financial advisors are not even considering. A scenario where the dollar's purchasing power declines significantly over the next decade. Start by understanding your exposure. If the majority of your wealth is in dollar-denominated assets, cash, bonds, bank deposits, you are essentially betting that the government will manage the debt responsibly, that inflation will remain under control, and that the dollar will maintain its value. Looking at the fiscal trajectory, that seems like a very risky bet to me. Consider allocating a meaningful portion of your portfolio to hard assets. Gold and silver are the most liquid and historically proven options. Real estate with fixed-rate mortgages benefits from inflation because your debt is repaid in cheaper dollars while the property value rises. Productive businesses with pricing power can pass along inflation to their customers. For precious metals specifically, I would suggest owning both physical metal and shares in quality mining companies. Physical gold and silver, stored securely, give you direct exposure with no counterparty risk. Nobody can default on a gold coin sitting in your safe. Mining companies offer leverage to rising metals prices because their costs are relatively fixed while their revenues rise with the metal price. A gold miner's profit margin can double or triple, even if gold only rises 50%. The key is to act before the crisis becomes obvious to everyone. By the time hyperinflation is on the front page of every newspaper, gold will already be at $5,000 and silver will already be at $100. The time to position yourself is now, while the mainstream narrative still says inflation is under control, while precious metals are still affordable for the average investor, while most people are still asleep to what is coming. I want to share one more story before I close because I think it illustrates why timing matters. In 2007, I saw the subprime mortgage crisis coming. I studied the data, I understood the risks, and I positioned myself accordingly before the crisis hit. The people who waited until Lehman Brothers collapsed in September of 2008 to start worrying about their portfolios, those people lost 30, 40, 50% of their wealth before they even understood what was happening. The people who acted in 2007, who positioned themselves before the consensus recognized the danger, they not only protected their wealth, many of them made the biggest returns of their careers. The same dynamic is at play right now with inflation and precious metals. The data is clear. The fiscal math is undeniable. The trajectory is set. The only question is whether you act now while the prices are still reasonable, or whether you wait until the crisis is obvious and pay 5 or 10 times as much for the same protection. I have spent my career looking for asymmetric bets, investments where the downside is limited but the upside is enormous, and I cannot think of a more compelling asymmetric bet than precious metals right now. If I am wrong, if the government somehow manages the debt without inflating, if the dollar maintains its purchasing power, if inflation stays at 2 or 3%, then gold and silver will probably generate modest positive returns. You will not lose money. You will just underperform stocks. But if I am right, if the fiscal math catches up with us, if the dollar's reserve status erodes, if inflation accelerates beyond what the Fed can control, then gold and silver are going to multiply in value many times over. The downside is modest. The upside is extraordinary. That is the definition of an asymmetric bet. And in my experience, those are the only bets worth making. The window to act is open right now, but it will not stay open forever. Once the market recognizes what is happening, and it always does eventually, the repricing will happen faster than anyone expects. And the people who position themselves early will look back on this moment as the greatest wealth preservation decision of their lives. Do not wait for permission. Do not wait for the mainstream media to tell you it is time. Do not wait for your financial advisor to suggest it. By then it will be too late. The math is clear, the history is clear, and the opportunity to protect yourself is right in front of you.